Hello, this is Ahuram. We'll be with you with US, to review the U.S. labor market data and check the market reactions as well. First of all, I apologize for the noise around. I'm a little out of the office, and maybe there's a little bit of the noise around, and maybe if it hurts you, I apologize for that at the beginning. But since this data they were very important. We had a very important data, and which is the market of so we can say that it's the most important labor data that we have in economic calendar. That's why I try to become online and talk about that and talk about the market reactions as well. So I accept my apologies first, and let's go forward. As always, let's check the data and see what we had as the data, and then we can go and see the market reactions and our expectations as well. Average earnings increased by 3.9% annually and 0.3% monthly. That was both they were better than previous month. At the same time, the annual scale it's increased to 3.9% from previous 3.8%. At the same time, the previous month's 3.7% also revised higher to 3.8%. Average weekly hours also increased to 34.3, a little bit more than 34.2 of previous months and expectations. We will see why that happened. Private sector hired only 83,000 new jobs. Like they had new hirings, while the government sector they lost 10,000 new jobs. I mean, they lost 10,000 of their employees. At the same time, the overall non-farm hirings, non-farm payrolls increased only 73,000, much less than 106,000 market expectations. This is while the previous month's number, which was about around 70,000, also reduced lower to 14,000. It means that previous month in June, we had only 14,000 hiring across the US. These numbers showing that labor market is very weak. I mean, not the very weak. We can say that the labor market is showing more weakening signal. This is the underlying risks that we had in the market, and underlying risks. One of those underlying risks that Mr. Powell, Chair Powell, was talking about that after Federal Reserve meeting on Wednesday. So generally, we can say that that's the reason when we have less hirings that support the idea of more working the current labors. That's why the average weekly hours increased to 34.3 hours. That's why the average earnings also, since they worked a little bit more, average earnings also increased by 0.3% monthly and 2.9% annually. I mean, that's the process that we can understand what happened there. At the same time, the thing is that still the unemployment rate is 4.2%. Yeah, it is a little bit more than 4.1% that we had in June, but 4.2% is not a bad number. It's very close to full employment level. The main reason is because that supply and demand both moving in the same side and it's the same scale. I mean, while we have less supply in the market, we have less demand as well. So that both supply and demand they are lowering, they're slowing down. So which means that it's not increasing the risk of the labor market. So while we have less hirings, we have less less demand for the jobs as well. That's why the unemployment rate is around 4.2%, which is not a bad number. So this is generally what's happening in the market. We can say that the labor market has more weakening signal, but at the same time, it's not a bad market. I mean, it's not such a concern. We don't have such a big concern around the market. The numbers somehow is fine. Let's go and see the data. With these data, what we can understand from these data. From these data, this is what we can understand. The Federal Reserve will have more reason now to talk again about two rate cuts, not one rate cut. Even still, the chance of the 25 basis point rate cut in September is around 50%, is not so much high. And it's not so much down as well, so much low as well. We need more data to watch before September Fed meeting. We have one more NFP. We will have two more inflation numbers. So it's so early to talk about that. But generally, what we can understand from these data that we have more underlying risk in the market, and we have to be more careful. So the Fed is right about the being wait and to have the wait and see policy. That's the market reaction. The US dollar, which increased to 100 marks, again down a little bit lower, around 98 point 60. Yesterday, after US inflation data, we talked about that. The US dollar index, even thought if the US dollar index increased to twice 100 marks, but still it can slow down after that. After that time, we can think about 98 mark for the dollar index, a little bit higher or lower for the at least for the short and midterm. We can talk about the 98 as the next US dollar index pivot point, we can say. We will have the dollar index around this level. Weaker dollar for sure can support the gold price, and that's the reason we can see that the gold increasing. At the same time, weaker labor market, we can increase the expectations for the rate cut. And rate cut, it means that the lower the yield, and when yields is slowing down, gold always increasing. So they have a opposite direction. So the less yields expectations supporting the gold price. That's the reason that we can see that the gold increasing. Even thought that before that in weekly outlook also we talked about the 2000 we talked about the 3,250, that if we reach this 3,250 a little bit higher or lower of this land, and all that's already the for now as the lower low that we could see, and now we can talk about the changing the market direction. And again, the overall gold still the positive, and that's what we can expect for now for time being. As the market is thinking about the less hawkish and more thinking about the towards more dovish policies that can support the gold, that can support the stock market. But at the same time, we had too many other data that they can put the pressure on the stock market. So these data, they are not such a big negative data. As mentioned, the unemployment rate is about the 4.2%. Even thought if we had a less hirings, but the unemployment rate is at the 4.2%. It means that the people are not looking after the job after they don't think that look, we had a participant rate of 62.2%, which is the standard number. It's not too high, it's not too low. So that can well, this number says that the while these data say that the labor market still has a small cooling signal, but at the same time, as far it's acceptable, we are in acceptable level, so we don't have too much concern in the labor market. So that's why it cannot change the direction of the stock market that's started in the previous days. We talk about that. Now it's the time to have a some risk and use that's what that's the reason. That was the reason we can talk about the possible correction in the stock markets. And if S&P 500 can hold this level 6,250 and fall more than this, we can talk about the next targets around 6,135 and then 6,000, and then we can talk about the 5,700. These are the next levels that we're expecting to see for the S&P 500. So we can say same, we can talk about the same downtrend in other markets, especially for the NASDAQ. We are talking about the 22,000. If we fall under 20, now it's the 22,080, 20,900. If we fall under 22,000, then the market direction can change. 42,000, same, you will have the same effect for the Dow Jones. And generally, the Dow Jones is still in a downtrend, and this downtrend can continue further. So these data, they are negative for the stock market. As another reason that they are negative for the stock market is because it's after these data and after with the ongoing geopolitical tensions that we have in the market just is increasing. When we have the higher risks in the market, the demand for the risky assets, including the stocks, can slow down. So higher risk in the market, slowing down stocks, slowing down price for the stocks. That's the opposite direction that you're opposite direction and opposite correlation that they have. So for now, we can say that the dollar, these data, they are somehow the positive for the dollar index, it's negative for the stock market. About the cryptocurrencies, well, these numbers cannot change the overall cryptocurrencies direction, and the currency cryptos are somehow in a correction movement at the same level, at the same movement with the stock markets. Cryptocurrencies, especially the Bitcoin, also can continue its correction under 114,700, the level that we were talking about. That under this level, we can talk about 112, 109. Those are the next targets that we're expecting to see the Bitcoin further. So yeah, that was the market data and the reaction. If you had any other question, don't forget to write in the comment section or try to get back to you as soon as I can. Have a good time. Bye.